Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today would have been Michael Becker, but he is doing another due diligence. That guy is the busiest guy I know. So sitting in the podcast today, James Eng with Old Capital. Hey, James, how are you?
Good, Paul. Thanks for having me.
So in the podcast today, it's another piece of just a little specialty learning on something that is near and dear to my heart. It's 4 little numbers that mean everything when it comes to real estate. Those numbers are 1031, better known as 1031 exchange. So in the podcast today, we're going to talk a little bit about 1031 exchange, some of the topics that are kind of timely on 1031 exchange, and it's really something for us to have a better understanding on when we own multifamily properties. So sitting in the podcast today, we have Craig Brown. Craig is a Senior Vice President and Regional Manager for a group called IPX 1031 in Dallas. So Craig, thanks for joining us in the podcast. We appreciate that.
Thank you. Thanks for the opportunity.
So I'm going to kick it over to James, and let's get it going.
Craig, so as we've seen the property values just rise over the last couple of years, a lot of investors are, taking money off the table, going to market with their property, and then they sell and they figure out, well, what am I going to do now with the proceeds? And so we wanted to bring you in to really, there's a lot of, I think, mystery around 1031.
Sure.
And not until you need to know, do you need to know. So we want to bring you in to really talk about what 1031 exchanges are, what some of the requirements are in terms of before it happens, during, and after. So maybe just to start off, explain what a 1031 exchange is.
Okay. A 1031 is just a reference to an internal revenue code section, 1031, obviously. And essentially what it does, it allows for a taxpayer to defer capital gains tax, whether that be tax from appreciation in value. So I buy a property for $100, I sell it for $150. I can defer the capital gain on that $50 increase in value. But it also, on improved property, I have depreciation that I'm allowed. So if I buy that property for $100 and depreciate it down to $80, that $20 of depreciation that I've taken has to be recaptured as well. And so 1031 allows you to defer the recognition of gain on the depreciation recapture. So in that example, you sell for $150, adjusted basis of $80. That's $70 of gain. If you follow all the rules, you don't have to pay taxes on that $70 of gain.
So let's jump into, maybe what are some of the requirements? So you sold it for $150 and let's say it was a multifamily property. Let's just add a couple zeros to that. So let's say $15 million, you sold it for $15 million. What can you exchange that into? So maybe let's get into some of the requirements that are required of 1031.
Sure, absolutely. In isolating on the value, let's talk about how do you have a total deferral. So if you want to have a total deferral, essentially what you do is you take your gross sales price, $15 million in this case, and you net off of that ordinary closing costs, real estate commissions, title premiums, escrow fees, direct legal expenses, and that's going to drop you down to what we refer to as a net sale price. That's going to be your target for how much replacement property you need to buy. So sometimes you'll hear people say you need to buy equal or greater in value. And while it's not a perfect reference to the gross sales price, that's just for conversation purposes what you typically utilize. We know it's a little bit less than gross sales price because you get to net off those closing costs. Now, for a partial deferral, that's a little bit more complex. This is not an all or nothing deal, so you do not have to accomplish a total 100% totally tax deferred exchange. You can have a partial deferral. To get to that point, though, you have to first buy replacement property that costs more than the adjusted basis of the property that you're selling. So it's really commonly misunderstood. It's not how much money am I purchasing in replacement property, that's what my deferral is going to be. You first have to pass through that threshold of adjusted basis to even begin to defer. So if you have a $15 million sell and a $10 million adjusted basis, if you only buy a $9 million replacement property, you'll have no deferral. If you buy an $11 million replacement property, then you'll have deferral of $1 million of gain. So that's the basics on looking at the values of the properties.
And is there anything around, I know we hear this word, like-kind exchange. I guess, can you explain what that means and how someone can move maybe from a commercial property, maybe an office, retail, industrial property into multifamily and vice versa? So talked about
Sure. Yeah, absolutely. And that's another one of the common things that we get people that call us about and they don't really fully understand. What is like-kind? When we're talking about real property transactions, essentially we're talking about all real property is like-kind to all other real property. Now there's what we call a held for qualified use. That property on the sell side and the property on the buy side has to be held, and it has to be held for investment or productive use in a trade or business. It can't be dealer property. It can't be property held primarily for resale. It can't be your primary residence, those types of things. So it has to be held for the investment or productive use in a trade or business. But you can mix those up. So you could sell raw land that you were holding for appreciation and value, and you could buy improved property as your replacement property that you're going to generate income on. And in a 1031, you can sell one, buy one, sell one, buy several, sell several, buy one, or several for several. So any combination, as long as it's real for real and it is held for qualified use.
And it's real property, but it doesn't have to be real estate.
That is exactly right. So different types of real property that exist are land and things permanently attached to the land, which most everyone's familiar with. But it can also be a greater than 30-year leasehold interest on a piece of dirt. It could be royalty interest in oil and gas leases. It could be working interest in oil and gas leases. It could be water rights. So anything that is defined as a real property right is real property. And so it can be exchanged for anything else that's a real property right.
How about airplanes for airplanes and paintings for paintings?
Airplanes for airplanes and paintings for paintings. So personal property, when you're talking about personal property assets, those things are significantly more restricted on the class. So they call it a like class exchange. So I can exchange my airplane for an airplane or my airplane for a helicopter. I've even done an exchange one time where we had a client that sold their small jet and bought 2 engines for their larger jet as replacement because it all fits in the same asset class. And so personal property, you have to look to general asset class first. If it fits into one of the general asset classes, that's where you stop. And if it doesn't, then you have to go to what's called the North American Industry Classification System Manual and determine what product class the asset fits in. So we can get in the weeds real fast on those.
So let's say I'm selling my property. So you guys are an intermediary.
Yes.
When can the money just come into my account when I sell the property, or where does it need to go, and sort of what is your role as an intermediary?
Okay, sure. So as a qualified intermediary, we're technically a principal in the transaction. We're not an escrow. We're not a fiduciary. We are a principal in the transaction. So we have to be involved in the transaction before the closing of the property, the first property that's going to be part of the exchange. So in a delayed exchange or forward exchange, as they're referred to as, where the taxpayer is going to sell their property they currently own first, then there's going to be a delay period of time until they purchase their replacement property. We need to be involved prior to the time that the relinquished property closes. We have to draft an exchange agreement, which is the agreement between us and our capacity as qualified intermediary and the exchanger. We have to draft an assignment of the exchanger's rights to sell the property, and we have to draft a notice of that assignment for the buyer. Then we coordinate with the title company or escrow for the closing. And then once that property closes, the net equity that would belong to the exchanger is wired off to us. We'll open up a segregated bank account just for that one exchange. We'll hold those monies, receive the identification within the 45-day identification period, and then we'll work, once they write a contract, the exchange agreement already is in place that covers the entire transaction. And so that's already there. So we'll just draft an assignment of the exchanger's right to buy the replacement property, a notice for the seller, and coordinate with that escrow on the purchase side.
So you're an attorney and you've been practicing for 25 years plus, and you've closed over, about 5,000 real estate transactions?
Yeah, I probably need to update my profile because it's been a lot more than that. But but yeah, we run a couple hundred a month through our Dallas office.
Yes.
Nationwide, we'll do over.
So
20,000.
you're an expert. I think what I'm trying to ask is that you just cannot be just a regular attorney to do this. You have to be an intermediary, have an intermediary account. It's a specialty.
The consumer should want a specialist in the area. That is true. The way that the Internal Revenue Code and the Treasury regulations are written, it's actually anyone that is not a disqualified party is by definition qualified. And there is no regulation at the federal level. There are a few states that have a licensing requirement. So technically anyone not disqualified can fulfill our role. But just in our brief little conversation so far, you can tell that's not a good idea for the consumer.
Jumping back, that was a great attorney answer. We work with a lot of investors, and in that identification period, can you give us a little bit more detail around that in terms of number of properties and how they go about identifying them? And then if during those first 45 days, if none of those properties work out, what happens?
Okay, sure. So the 45-day identification period, it begins with the closing of the first relinquished property. So remember, you can sell one or you can sell several in a particular exchange. So the closing of the first relinquished property is day 0. You have 45 calendar days. It's extremely important to understand that if the 45th day falls on a Saturday, Sunday, or legal holiday, you do not get until the next business day. That's different than most every other place in the law. So the 45th day is the 45th day. By midnight, you have to have your identification in place. There are 2 basic rules for identification, the 3 property rule and the 200% rule. If you satisfy the 3 property rule, you do not have to move on and also satisfy the 200% rule. The 3 property rule says that you can identify 1, 2, or 3 potential replacement properties without regard to the aggregate fair market value. And then ultimately you can acquire any 1, any 2, or all 3 of those properties. So if I sell for $100, I could identify 3 $1,000 replacement properties and be perfectly fine. If, however, I want to identify more than 3 potential replacement properties, then I have to move to the second rule, the 200% rule. It's labeled the 200% rule because it references the aggregate fair market value that can be identified, and it references back to the gross sales price of the relinquished property. So if I sell a $100 property and I want to identify 5 potential replacement properties, I have to add up the fair market value of all 5, and that sum cannot exceed $200 in this example. That's a very tight threshold. So typically where you see the 200% rule used is whenever you have a taxpayer selling a relatively high dollar asset and they're buying several smaller dollar assets. Or you see what's referred to as a multiple property exchange, where there is real and personal property being sold on the relinquished side, and there is real and personal property being acquired on the purchase side. Necessarily, you're thrown into a 200% rule identification because each individual asset is a separate property for identification purposes.
So let's go back to example. Most people are identifying, let's say, 3 properties. And if they only identify 3, do they provide you with the estimated purchase price of those 3, or does that not even matter because you're qualifying based on that rule?
Yeah, on the 3 property rule, we typically do not require any type of dollar value to be placed on the form because it is a 3 property rule and the aggregate fair market value is not important.
Okay. So if they identify 3 and then let's say it's in the middle of a bidding process right now, so they don't know if they're going to win those properties or not. And then at the end of the 45 days, what happens if none of those 3 work out?
So that's the worst case scenario, right? So you get to 3 properties identified and you end up not being the successful bidder on any of the 3 and you're post day 45. Now you're out of luck. Okay. It's kind of the double whammy as well because you have no opportunity to amend your property identification post day 45. And the way that the Treasury regulations are written, there's what's referred to as the G6 limitations, Treasury Reg 1.1031 K1 G6. It's just fun to cite that. So anyway, that says that we as the intermediary cannot release the proceeds until there is a technical termination of the exchange. And because those properties were properly identified within the 45 days, they are still deemed available to be acquired. The fact that you can't negotiate a price with the seller is immaterial to whether or not they are, quote, available. Therefore, we have to sit on your money until day 181. So the exchange terminates on the 180th day. The next business day, we're allowed by law to return those monies to you.
I didn't know that.
What? So wait a second. Let's say on day 46, I do find a property, but it wasn't part of my 3 property. You mean I can't get my money until 181 days?
You cannot get your money. So you'll have to wait to close on that next property, that non-identified property, until we can send your money back to you, and then you can send the money out for the acquisition of that replacement property, which it won't be a replacement property for your exchange. It'll just be another property you're going to buy.
Wow, I did not know that. So tell us a little bit, up leg, down leg, define what those terms mean.
Sure. You hear a lot of different terminology, and it's not always intuitive as to what it is. So the property that you are going to sell, the one that you currently own that you want to sell, is typically referred to as the relinquished property. Sometimes you'll hear it referred to as the down leg or downstroke. It's the property that you're getting rid of. The property that you're going to acquire is the replacement property or up leg or upstroke. Sometimes you'll hear it referred to as. And then there's another term that's out there that you hear that's called boot. So you hear about the term boot in a 1031 exchange. And boot typically takes the form of cash, or it takes the form of debt relief. So I sell a property for $100, and let's say I have a $40 mortgage on that property. $60 is going to roll into the qualified intermediary. So if I tell my qualified intermediary I want to put $50 of that $60 down and buy a $100 replacement property, I've satisfied my mark. I've hit equal or greater in value, but I've only reinvested $50 of the $60 that I had from the sell side. So I have $10 left over. That's referred to as boot. And because it was in the form of cash, we call it cash boot. Okay. And so I would owe taxes on that boot. It could take the form of debt relief. So now I sell for $100. I have 40 mortgage being paid off, 60 into the QI. And let's say that this time I'm going to buy a $90 property, but I tell the QI send the entire 60 and buy the $90 property. Well, I had $40 of debt paid off on the sell side, only $30 of debt on the purchase side. So I had $10 of debt relief that was not offset. That too is going to get taxed. And it's the same tax. It doesn't matter whether it's cash or debt relief.
Talk a little bit more about that boot when it comes to, let's say, a mortgage is $100 remaining unpaid balance, but when they pay it off, there's a prepayment penalty or yield maintenance penalty of $5 or so.
Right. So different taxpayers will treat that differently. If there is a penalty, they may treat it as part of the debt relief. Whether or not that will withstand audit, we don't know. But that $5, that extra $5, some will treat that as debt relief. And so you have, say, a $40 mortgage and $5 prepayment penalty,
right,
and they'll treat it as if they had $45 of debt relief and offset that on the purchase side. The safer methodology for that would be to pull $5 out of your pocket, pay the $5 so that you have $40 of mortgage debt payoff, $60 of cash into the QI, $60 rolling forward to buy the replacement property. Now, if you get into a structure that has an actual defeasance, then it's probably a full day seminar on whether or not you can do that defeasance and do it so that there's no boot in the 1031 or not.
Paul and I just found out about that, sitting your money for 180 days if you don't find out about the right property. Is there anything else? I mean, most people get into 1031 exchanges and they're only thinking about the good, not paying the tax man. But any other surprises or hooks that
Give me the top 5 books.
that investors need to know about sort of before their money goes to you.
Sure. Yeah, I think, we always tell people don't let the tax tail wag the dog, right? You don't do a 1031 exchange just to do a 1031 exchange. You do a 1031 exchange because you have a property that you want to sell and you think that there is a probability that there is a property that you're going to find that you want to purchase, or you already have one picked out and you know that you're going to purchase that property. And you're making a good business decision first. And now you're going to do it in the most tax advantage fashion. Now, those that are savvy about 1031 and understand 1031 factor that into the decision of whether or not to sell a property or not. Absent the ability to defer gain under 1031, there are many people that just simply would not sell their property. Okay. And in fact, there's been some contemplation of some elimination of 1031 exchange. We think we're beating that back, but there has at least been discussion of it. And there was a study done that showed that as much as an $8 billion negative impact on an annual basis to GDP by eliminating 1031 exchanges. So while you want to make a good decision, 1031 can factor into that. That's probably, though, as far as tying the money up, that's the one that's probably the biggest gotcha in 1031. In fact, in our document package, we have a separate form that only deals with that one topic because it's not necessarily intuitive, because from the taxpayer standpoint, if they don't buy something on the list, they're going to still be responsible for all the same tax liability that they ordinarily would. The problem is that the intermediary, if they violate the Treasury regulations and they violate the contractual obligation with the taxpayer, there could be adverse consequences for the intermediary, and the intermediary could be deemed to be performing the role of an agent of its taxpayers and therefore jeopardize all of the other clients of the intermediary. So we kind of chastise what we refer to as the accommodating accommodators, because they're not doing a favor for one client, they're jeopardizing all their other clients.
I was just curious, do you have any stats on, when people identify their 3 properties, what percentage actually don't make it? Any idea?
Well, I don't have any empirical data on that. I could pull it, but we have very few exchangers in commercial properties that do not complete their exchange, that are intending to do an exchange and already have something in the pipeline. Okay. They may prospectively say, look, I'm going to throw this into an exchange because I want an extra 45-day look. Because on a commercial transaction for a fee under $1,500, it's worth that to get another 45 days to try to find something. Now they know they've got a bird in the hand. They can go looking for property. Some of those have a higher propensity to not find replacement property. In the 1 to 4 family market, it's hard not to find something that's worth buying. So
yeah, the multifamily side that we have, I just had a gentleman fly in to Dallas last Friday on the red eye coming out of San Francisco, came in at 2:00 because he's on day 43 out of 45, and he had to execute a contract, find the property, walk the property, put it under contract, and then start the process going because he was right down to the end. I think that's one of the things on exchanges is that if you don't think you're going to get the deal, you kind of artificially push up the sales price on the property to try to get it to avoid the taxes. So that's one of the things I do see is that people are forcing their hand to buy the property. So they're trying to overpay for a property sometimes in this market. A question that I have that I've seen just recently, which I thought was kind of a wild one, is a person's on the property for a number of years, and then he's thinking about selling it and donating the proceeds down the road. But what he's doing right now is that he's refinancing, pulling some cash out before he sells the property. So he's refinancing, pulling cash out, and then he's going to do whatever the remaining balance is that we were able to pull the cash out and do an exchange to the next property. What do you think about that?
I think that refinancing the property that you're about to sell is significantly more aggressive than refinancing the property that you purchase. The case law tells us that you have to have an independent economic reason for the refi and that it's not simply just a cash out. That's a little bit difficult of a burden to carry if you're refinancing the property that you already have under contract to sell, as opposed to property that is purchased as replacement property in an exchange. Now, necessarily, you have to plan on indefinitely owning that property. Something could change, but you have to plan on indefinitely owning that property. And there's all types of independent economic business reasons that exist that you could justify why you wanted to refinance after the acquisition.
Yeah, he was looking to refinance it. He's owned it for a number of years and put the proceeds to an endowment for a university. So it was one way of taking cash out of the property that he didn't have to go through the exchange piece.
Right. And so that is something that the IRS could look at and say, that's just an attempt to cash out, as opposed to using it for a valid economic purpose in relation to that property.
Another question, 1031 is a federal law. Is there any state laws that we need to be aware of throughout the United States that may have some gotchas too?
Sure. Each state has some different components. So, for instance, Texas doesn't have a federal income tax, so we don't have a 1031 equivalent in Texas. California tracks the federal law. So if you defer at the federal level, you defer at the state of California level. Now, a few years ago, the California legislature did create a gotcha, and you sell California, and for example, let's say you come by Texas, you defer at the federal level, you defer at the state level, but then let's say 5 years later you sell and you don't do another exchange. The federal government wants you to recognize your gain, sell price minus closing costs minus adjusted basis, pay it at the appropriate rate. Now the state of California wants you to come back and recognize the gain that you deferred when you left. In fact, they created a scheme where you now have to file an informational return, even though you may not be a California resident. You have to file an informational return with the state of California when you leave California with a 1031 exchange. And so every year you have to file that return and report that you still own a property or you did another exchange and you still have a continuation of the investment. So that's a gotcha. So there's a few states that have some rules that differ from the federal rule.
And going back to California, we've had some people that own properties in their individual names out in California, and now they're selling a property out in California. They're bringing the proceeds to Texas, but they want to do a Fannie Mae loan. Fannie Mae is not going to do it in the name of an individual. They want to do it in the name of an LLC. So it's kind of a transfer of the vesting of the property from individual to an LLC. Any gotchas in that?
Well, when you drill down to the core component, it has to be whatever federal income taxpayer sold, that same federal income taxpayer has to buy. So if Sally sells her property in California and she wants to buy in a SPE here in Texas, she can use a single member LLC. So NewCo LLC would be set up. It would be the borrower, it'd be the legal title holder, but Sally would be the sole member of the LLC. And that LLC would not elect to be taxed as a separate entity. So by default, it is a disregarded entity for federal income tax purposes. So for federal tax purposes, it's the same vesting. Sally sold, Sally purchased. For lender issues, liability purposes, state law purposes, it's a different owner.
What if Sally brought $2 million, but they needed another $1 million, and someone else came in to bring that $1 million? How would you guys structure that?
There's two basic ways to structure that. Is Sally could buy an undivided fractional interest in the replacement property, and new investor could buy the remaining undivided fractional interest. There's a new vehicle that it's used quite often at the institutional level. It's not as often seen at the individual level. It's called a Delaware Statutory Trust. And gross oversimplification, but essentially the Delaware Statutory Trust could buy the property, and the beneficial owners of the trust are deemed to be treated as if they have an undivided fractional interest. So DST could be the borrower, buy the property. Sally could buy beneficial interest. A new investor could buy beneficial interest. you technically have one owner, but for 1031 purposes, Sally's treated as if she bought a fractional interest.
Paul, have we had much luck with DSTs and tenant in common?
It's tough. There's no doubt about that. The structure itself, probably works the best in a crowdfunding piece, but as individual investors, not very much. But kind of talk about tenants in common, because we do a lot of tenants in common transactions. And again, why would somebody have a tenants in common?
Sure. Tenancy in common is just so you can satisfy that requirement that you maintain the same taxpayer throughout the exchange. So Sally sells, Sally buys an undivided fractional interest held as a tenant in common with the other investors. Now, all the other investors could organize as a partnership. So they could set up an LLC, and it could be Sally buys a 10% undivided fractional interest, and 9 other investors form an LLC and own 90% undivided fractional interest. That's perfectly fine. But tenancy in common is just a mechanism to satisfy the 1031 vesting requirement and still have everyone contribute, new investors contribute dollars to that investment. Now, I think let's go away from Sally being the sole seller. Let's say that you have a multi-member LLC that sells a property, and it wants to buy a much larger replacement property, and so it needs new money to come into that LLC. Well, what you typically would do then is bring those new investors into the existing LLC. So instead of trying to create a new LLC, which, LLC 1 that's selling the property can't purchase membership interest in LLC 2. And initially you might think, well, let's set up LLC 2, have the 3 members out of LLC 1 and the 7 new investors come together and be members of LLC 2. Well, that doesn't work. And LLC 1 can't buy a 30% membership interest in LLC 2. That doesn't work. But the 7 new investors can invest in LLC 1 and move into LLC 1, and LLC 1 be the one that completes the exchange. So sometimes what you initially think you want to do might not be the correct path from a 1031 perspective, but from a 1031 perspective, there might be a very viable solution.
What's that called?
It's just adding new partners. They're just contributing proceeds into LLC 1 that was the seller of the relinquished property.
And I've heard the term reverse exchange. Can you explain that?
Sure. Reverse exchange is where a taxpayer needs to acquire their replacement property first before they have sold the property that they currently own. And so it just means we're going to do everything in reverse order. However, as we've been talking here, we've never contemplated that my company, a qualified intermediary, would need to take title to anything. Remember, we referenced exchange agreement, an assignment of the rights, and a notice, but we never talked about the deed flowing through us. Well, in a reverse exchange, you can't have the taxpayer, the exchanger, they can't have title to both the property that they're going to relinquish and the property that's going to be their replacement property at the same time. So we have to segregate that ownership. And typically what will happen is we will, in a new capacity called exchange accommodation title holder, set up an LLC. The taxpayer and or their lender will loan money to us. Our EAT LLC will purchase the replacement property, and we can sit on title for up to 180 days, giving the taxpayer time to sell the property they currently own and then purchase the property that we park title to from us. Okay, now that's staying within the safe harbor. That was a safe harbor that was issued back in 2000, Revenue Procedure 2000-37. There's a relatively recently decided case, not a relatively recent fact pattern, but a relatively recently decided case called Bartell that suggests operating outside of that safe harbor may be a little bit easier to accomplish than originally thought. It's not quite as simple as just saying we can park title to what ultimately will be the replacement property and you can ignore the 180-day safe harbor. But there is a case, the Bartell, it's a Ninth Circuit case, that suggests that the accommodating party, now we're not going to call them an exchange accommodation title holder only because that's a term of art specific to the revenue procedure, the safe harbor. Now this accommodating party might be able to stay in title up to 2 years to give the taxpayer the ability to sell the property they currently own and acquire from the accommodating party the replacement property. That's especially important when you're talking about a reverse improvement exchange, where the target replacement property needs significant rehab or where it may need new construction, maybe a piece of dirt that wants ground up construction. Well, it may be a year or year and a half build out. And that Bartell case gives us a mechanism, gives us some authority to say that we should be able to accomplish that transaction.
So in a lot of these transactions, I mean, have you seen where maybe the lender had an issue, or what issues come up when you take title? Because a lot of times we talk about, they're underwriting, the lender's underwriting not only the property, but they're underwriting the borrower. So now all of a sudden it's you and they don't know anything about you.
Right. And so for purposes of the loan to the exchange accommodation title holder, it's going to be fully non-recourse as to our entity that serves as a sole member of that LLC. But what the safe harbor allows to happen is that the lender can still underwrite the actual taxpayer. So it's okay for the exchanger to guarantee the loan to the exchange accommodation title holder. And so typically that's not an issue, but from a lender perspective, one thing that the lender is looking at is how long is my money going to stay out, and am I going to experience a very quick pay down on the money that I loan? So for instance, if I'm buying a $100 replacement property and the lender is willing to loan us $70, so the exchanger loans us $30 and we borrow $70 from the lender, but on the exchanger's relinquished property, they have no debt. They're going to sell for $100, no debt. So now $100 comes into the qualified intermediary from the sale. The qualified intermediary pays $100 to the EAT LLC. The EAT LLC pays the exchanger back $30, and now the EAT LLC needs to pay the $70 back to the lender. Well, do you want your loan only out for 92 days or 103 days, whatever the case may be? So that's an issue. And then also, how are we going to go off title? Normally, we do an assignment of the membership interest of the LLC to the exchanger as their replacement property, because if an exchanger acquires 100% of the membership interest of the LLC, it's treated as if they purchased the property and not the asset. So that's typically the way that we'll do it. So now your loan is to EAT LLC. The LLC interest will be assigned to exchanger. So EAT LLC is still the borrower on your note. But it may be a structure where we can't assign the membership interest. So EAT LLC needs to deed the property. So do you want a loan payoff and a new loan, or are you going to allow for one assumption of that loan? So those are some of the things that you need to work out in advance with your lender. The non-recourse character of the loan to the owner of the LLC, EAT LLC, how long the money is going to be out, and then how are you going to transfer title to that property.
That's why you need somebody like Craig to explain that, like a 3-year-old to me, what the heck that all means, and show me the big pictures and the balloons, and this is how the money flows, and this is how you don't go to jail. I mean, that's the type of stuff that Craig has the ability, his team, that can offer. Some people typically have single families that are rentals, 1, 2, 3, 5, and they say, hey, listen, just like Monopoly, I'm going to sell these 5 single families and I want to buy something else with it. What are the gotchas in the single families? That do you have to sell them all at the same time? Or all has to come into to your group, the proceeds of the deal? Tell me a little bit about that.
Okay. So if we're going to sell 5 and we're going to buy 1, then we'll take the most simple variety of that is you sell all 5 in one closing.
Yep.
Now, rarely does that happen. So you close on the first relinquished property at day 0. You may close on the second at day 10, the third at day 20, the fourth at day 30. It's fine. You can sell everything that you're going to sell all the way up until you need to close on what it is that you're going to purchase. Right. So you want to sell everything first and then buy. Now, the one gotcha there when you're selling over a longer period of time, if you're going to sell a relinquished property after the 45th day for identification, if the sale of the subsequent property has no bearing on what it is that you're going to purchase, then your identification is going to be the same. But if I think I'm going to sell 5 and I have only sold 3, and if I only ultimately sell 3, I can only buy a $300 property, but I really want to buy a $500 property. So in my identification, I need to identify at day 45, one $300 property, one $500 property. And then I can make it my decision about the third one. Do I want to identify another 300 or do I want to identify another 500? Because by day 45, I have to have my identification to cover either possibility that I'm ultimately going to get to sell all 5 before I get to go close on my replacement property or not. That's the difficult part when you're selling over time. Now, the other thing that you could do in that scenario is you could say, okay, I've now sold 3, and at day 45, I'm going to identify a 60% undivided fractional interest in a $500 property. And you could actually combine 2 exchanges together. Now, we could take this to our logical extreme. We call this the 360-day exchange. And the reason that we call it that is day 0 is the closing of the first relinquished property. Close the second, close the third. Now day 45, I identify 60% of a $500 property. And I wait until day 180 to close on that 60%. But I also employ an exchange accommodation title holder to close on the remaining 40%. I then have another 180 days to sell relinquished property 4 and relinquished property 5 to come back in on the other side and buy from the exchange accommodation title holder that 40% undivided fractional interest. So sometimes we'll find people that have multiple properties that they know it may take them 6, 9, as long as 12 months to sell. And we can actually make that whole process work, even though they're going to ultimately own one replacement property.
So if people are not convinced that Craig is the right guy to go to, is there any other stuff that separates you as a qualified intermediary or your company as a qualified intermediary out there? Any differences between you guys and other shops?
I would think, obviously, we feel like we're going to give better service. But a few things that do segregate us is we do use separate accounts for every transaction. And there are a lot of other intermediaries that do that same thing. We do carry, though, an extraordinarily large fidelity bond. We have a $100 million fidelity bond, a $50 million performance guarantee that's written by one of our sister companies. We have a $30 million E&O policy. Our top tier parent company is Fidelity National Financial, which controls about a third of the title business in the U.S. Now, it doesn't matter where you're closing title, we'll still handle the transaction. And we do all kinds of personal property, like you referred to as well, exchanges. We're also extremely active in sitting down through the American Bar Association tax section with IRS and Treasury and working on some of these little nuanced items. Our general counsel is plugged into that aspect of our business. And so, we tend to be at the front side of what the IRS is willing to allow for taxpayers to do. So those types of things really set us apart.
Yeah, there's so many benefits to having a 1031 exchange. I mean, we definitely can see that, even though it can be technical, you really want to count on an expert like Craig and his group. But, what are the costs in something like this? I mean, if it's a $5 million exchange, if it's a $1 million exchange, just to give people a perspective, this is just kind of a ballpark. What is the estimate cost on an exchange?
This is what's going to shock you. We really are kind of a volume type business. We'll do over 20,000 exchanges this year. But a normal, like a single family, 1 to 4 family residential transaction, we charge $1,000, and that includes everything that we'll do on the sell side and everything we'll do on the first buy side property. If you have additional closings, like if you sell more than one or you buy more than one, it's $250 for each additional one. A commercial transaction, just a plain vanilla commercial transaction, typically is going to be $1,500, maybe a little bit less. Same thing, 1 for 1 with $250 added on. Now, a parking title transaction, those can get a little bit more costly because we are spending a lot more time working with the lender to make sure that all the documents are in order. There's liability, there's risk. We're a real owner for environmental purposes. We're a real owner for FERPTA issues. We're a real owner. We are a real owner, so we want to be compensated for being a being a real owner. So a typical transaction, let's say a $1 to $3 million transaction, is typically going to cost you maybe $8,500 or a little bit less for us to take title on a reverse exchange or an improvement exchange. So still not a staggering fee for what's being done on those transactions.
And again, what are capital gains these days?
Well, yeah. So the minimum capital gain for, anybody that's really an investor in real estate is going to be a 15% tax on gain from appreciation in value. That bumps up to 20% for a single person if they have more than $400,000 of taxable income, $450,000 if they're married. That counts the gain from the sale of the property. You may also have, I guess, what's referred to as the Obamacare 3.8% tax layered on top of that. If you go past the $200,000 modified adjusted gross income, single $250,000 if you're married, then you have a 25% tax on the recapture of depreciation. So if you bought a property for $100,000, depreciated $20,000, on that $20,000 you'd pay a 25% tax, or $5, in tax on that. So,
James, is it worth it? Because I just can't figure that out.
As long as you can identify in 45 days and find the right property. I mean, I've seen a lot of people, they really, and this can really go into when you're selling your property, is they don't really sell until the next one's under contract.
That's it.
So they're not going to put $1, $5, $10 million at a 1031 exchange intermediary unless they have the next one locked up.
Right.
So
yeah, I think that's a very fair statement. That's kind of what we referred to earlier, is very few of our commercial deals fail to buy a replacement property because they already have the replacement property picked out. Now, one thing, especially in 1 to 4 family, with how hot the markets are in a lot of places, you don't have to have a property under contract within the 45 days. Technically, you don't have to have the property under contract. In fact, the property doesn't even have to exist within the 45 days to identify it. We have a lot of clients that buy brand new single-family residential properties, and when it's time to identify them, it might be 123 Main Street, but that's just a scraped lot and forms. And they need to go ahead and identify 123 Main Street. It's going to be a 3-bedroom, 2-bath, 1,343 square foot, attached a little diagram that the builder's given them. And that property will be completed by the 180th day so that they can close on it. But at the time of the identification, it doesn't even exist yet. So,
Greg, what is the best way for investors to reach out to you? And then when would you want them to reach out to you?
Sure. We have a toll-free number, 888-337-1031. So 888-337-1031. That's the best number to reach us at. And then we have a website. You can go to our website, ipx1031.com. But that toll-free number is the best way, assuming that it's an individual selling and the individual is going to buy, or they're going to buy in a disregarded entity. Then they can just contact us when they go under contract for the property that they're selling. If there are investors who are in a partnership now, an LLC, limited partnership, and not everyone wants to stay together and go into the next deal, they need to call us significantly in advance. Going under contract changes a lot of possible solutions to exiting partners out of a 1031 deal if not everybody wants to stay together. So they want to call us well in advance of going under contract.
Would you buy those people out first and then go under contract? Is that what's the...
There's multiple potential solutions, and it just depends on what some of the risk profile of the investors are, where they're at in the country geographically. That can have an impact because of some of the state law issues, or some of the state tax collecting agencies are a little more aggressive than even the IRS. And so it just depends on the overall goals. And as a qualified intermediary, we're not making those calls and we're not giving that advice. We're really spotting issues. And then we have a network of tax attorneys that have worked on these issues before. So our clients typically are not paying an attorney to learn how to advise them. They're going to deal with people that have worked on this many times.
Greg is a specialist. You need specialists in your group of trusted team members. I think it would probably be a good idea to get onto their website, take a look, and see what's available out there. James, anything more to ask?
And I think, Craig put together a small 4-page flyer for our group, and then also a larger, I think it was like 65 pages that I have printed here on 1031 exchanges. So you can reach out to us. You can go to our website, oldcapitalpodcast.com, and request those pages, and we can get those to you. And it has all of Craig's information on there as well.
Craig, we very much appreciate you guys helping the investors out there on the exchanges. Some great information today. Anything else, James, we should be talking about?
No, I think if you haven't received our 15-page white paper on multifamily financing, you can go to the website and request it there, oldcapitalpodcast.com.
And if you do have a chance to get on to iTunes or Stitcher and leave us a 5-star rating, and maybe tell a friend, another apartment nerd, about our podcast, we would appreciate that. Again, 5 stars, hopefully, on iTunes and Stitcher. Craig, thanks for being in the podcast. We appreciate that.
Thank you.
I appreciate that. And then James Eng, thank you.
All right. Thanks, Paul.
I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.